Hey traders and investors, it's Serge Berger here. Over the next days and weeks into the middle part of December, we have several important data points coming out that are going to likely not only affect just the regular stock market, but particularly banking stocks. The specific events are this Thursday's ECB, the European Central Bank's interest rate statement, where they're expected to get more dovish, i.e. do more QE or go even more negative with interest rates. And then, of course, on Friday, we have the November payrolls, the U.S. jobs data, which will be one of the last key data points for the Fed to then decide on the 16th of December whether or not they want to raise rates. Those 3 points, those three data points likely have a lot of influence on banking stocks. There's a couple ways I'm looking at potentially trading these banking stocks, and to give you guys a little bit of perspective, this here is the inverse of the yield spread between the 10-year U.S. Treasury bond yield and the 2-year U.S. Treasury note yield. To make a long story short, if this sounds too complicated, basically what this represents here, this is, as you can see, the slope's going up. What it actually means in this case, we've had a flattening yield curve since the middle part of the summer or so, okay? And that's not something that really speaks for a lot of bullishness for banking stocks, because what this basically is telling us the banking stocks essentially aren't really, or at least the financial traders out there in this market are not exactly sure that we're actually going to see a rate hike. So it's entirely possible that the Fed may come out and hike rates in December, but then come up with some sort of dovish statement that sort of almost makes it neutral, and that will then not be good for banks. So that's sort of the bear case against banking stocks, is what the actual interest rates markets are telling us. If you look at sort of the TLT, which is the price of the longer dated U.S. Treasury bonds, you can see we've kind of been waffling. We've rallied a little bit here over the past couple of weeks, but more or less we've kind of flatlined and chopped back and forth ever since the middle part of May or so. So we haven't really gone anywhere in the broader sense, although it's been a little bit choppy. Now, if you look at the banking stocks, however, we see an entirely different picture emerge, and that's where things get really interesting as far as I'm concerned. So first of all, if we look at the BKX, which is the KBW Banking Index. This index, and I'm going to go with a plain white chart so as to get rid of some of these moving averages and give you a little bit of a clear picture. What you can see is we've once again made a higher low this summer versus the 2014 lows, and we now have a couple of points of resistance, or a clear line of resistance that comes in here. If we can overcome this line of resistance, then I think the path of least resistance to the upside. Alternatively, if we break below lateral support, which comes in roughly somewhere around here, where actually, I'm sorry, it's down here. It's a little bit lower where I marked this. If we were to break below here, then all bets would be off again as far as I'm concerned. So you can see a break to the upside could really be meaningful here, and that would probably be accompanied by some sort of more hawkish action or statement on part of the Fed. You can look single name stocks like JP Morgan in this space, very much the same type of pattern. So not surprisingly, obviously, because the KBW Banking Index is obviously made up of some of these big stocks. Wells Fargo, same deal here. You can see we got resistance. And let's look at the XBD, which is the broker dealer index. And this thing's at a really interesting spot. I'm going to add in here the 200-day moving average for you, and it's coming out in blue here, and you can see the really crucial spot that we've come to in the XBD. Not only is it made up of the 200-day, which it's trying to climb above here. Now you can see we're coiling up, so technically that's actually quite sound, but also for risk management purposes, we do have support right down here. Right, so if we're to break below there, I think the bet should be off, at least if we close there below a daily closing basis. Also, if you want to make it a little bit more complex, you can see if we measure the highs from the summer down to the autumn lows, we've now retraced exactly 61.8% of that entire sell-off. So there's an area of confluence resistance coming in right here, and if we can overcome that on a daily closing basis, I do think these broker stocks, particularly, and that includes Morgan Stanley's, Goldman Sachs, those kind of stocks, could really see a resolve to the upside. So from a trading perspective, how do you position for this? Well, I think less risk averse, i.e. more aggressive traders could probably already try to initiate a small long position here with a stop here at these lows, while the more risk averse, i.e. more caution trader probably wants to wait until we see some resolve, at least from the November payrolls on Friday, but maybe even on the 16th from the December FOMC meeting, and then see if we see follow through buying on the upside. I think there'll still be plenty of time to get long these stocks into year end and the early part of 2016. I hope this makes sense, guys. Please like the video, subscribe to my channel, and I'll see you guys in the next video.